All right, in this last lesson in this chapter, we're going to talk about the sale of a plant asset. Really straightforward, really easy. The only thing that's a little bit difficult in this kind of section or this example is this idea of bringing depreciation up to date. And so typically what happens is at the end of the year or end of the month, we would calculate depreciation. If we do it at the end of the year, we would do those on 12/31 or the fiscal year of the company. Well, what happens when we sell a piece of equipment in the middle of the year or the middle of the month? And so we have to, at that point, bring depreciation from January 1st all the way through when we actually sell it. Okay, so instead of waiting until the year end and do depreciation on a yearly basis, we have to prorate that for the time period in which we actually use the equipment and then dispose of it. Okay, so in this example, Red Rock decided to remove their equipment they have had for the last 5 years as of on January 1st. So as of January 1st of this year, the depreciation sits at $25,000. So they've taken 5 years of depreciation, $10,000, subtracted from 35, which was the historical cost, to get us $25,000 in book value. So on January 1st of this year, it had a book value of $25,000. Depreciation is calculated on a straight line basis, residual value of $5,000 over 15 years. So Red Rock sells the equipment to Tyson Equipment for $28,000 on June 1st of this year. So remember, we have two steps here. Step number one is that we bring depreciation up to date, and then we would calculate the gain or loss. So how do we bring depreciation up to date? Well, first of all, we got to figure out what depreciation they would have had this year if they had it for the entire year. In this case, $35,000 minus $5,000 gives us $30,000. This is a straight line, so it's very easy. $30,000 divided by 15 gets us $2,000 per year. Now, there's two ways of going through this. The way number one is you can figure out how much time we've had this equipment for this past year. Number two is you can just divide this by 12 months and then multiply it by the time that we had it. Okay? So in this case, I'm going to use just 5/12. Now you might say, Pat, why 5/12? Well, it's 5/12 because we had the equipment for January, February, March, April, and May, and on June 1st we sold it, which means we didn't actually get to use it in June. We sold it on June 1st, so 5 months. So I'm going to multiply this by 5/12, and that gives me $833.33. So what I would do in this case is that I would, in my books, debit depreciation expense for $833, okay, and then credit accumulated depreciation for $833. So that's what I would do. Now I got to do step two. Step two is to figure out the gain on the disposal or loss on the disposal. Okay, so I'm selling this to Tyson for $28,000. The question is, what is book value today? Well, book value, or the day that we sell it, okay? Well, it would be $25,000, but we used $833 during the year, which means that we would have $35,000 minus $10,833, okay? Why $833? Well, because we had $10,000 accumulated depreciation, we're adding our depreciation for this year, so that would give us $10,833. That would give us a book value of $24,167. Okay, so $24,167. And so now we calculate the gain or loss on this equipment. Well, I sold it for $28,000. In my books, it's at $24,167, which means I have a gain of $3,833. Okay, so I sold it for more than what it's worth in my books. Therefore, I booked a gain of $3,833. So let's go through the journal entries for the actual disposal or the disposition of the equipment. So what did I receive? Well, I received cash from Tyson for $28,000. Okay. And then I got to get rid of the old accumulated depreciation and the old historical price. This is a credit in our books, so now we need to debit it. Accumulated depreciation of $24,167. Sorry. Accumulated depreciation was $10,833. Okay. And then I got to get rid of the $35,000 because the equipment is no longer in our possession. So credit equipment for $35,000. And that leaves me a little lopsided here because I've got $38,833 and I've got $35,000. So I am missing $3,833 because that would have been $38,833 minus 35 is $3,833, and we know where that is because that is the gain on disposal of $3,833. Okay, so that would be the journal entry for the actual disposition. So again, step one is that we need to bring depreciation up to date. Okay, depreciation's up to date because of this, and then we need to also book the disposition. Well, I received cash. I no longer have the accumulated depreciation because the equipment's gone. I don't need the equipment anymore. And then I have a gain. So I made $3,833. So that is an example of sale of a plant asset. And in this case, there is a gain. A loss would work the same way. We would just move this gain to here. And instead of gain, it would be a loss up here and then the equipment down there.